Hello, ladies and gentlemen. This is Mohak, founder of Technically Sorted. This podcast that you're listening to is my very first podcast. It is going to be a series of podcasts on trading psychology. And today, I'm going to talk about trading psychology broadly. In today's day and age, as years have gone by and electronic trading has become very well known, very accessible, and very famous among individuals, a lot of retail and professional traders want to up their game continuously. The acceptance of the topic of trading psychology has grown over time, and as we speak, there are many people who are actually very okay with expressing and understanding more about themselves as traders. Now, trading is a journey, and learning to trade is something which is very personal to each individual, depending on his aptitude, depending on his or her aptitude, depending on his or her intellect, depending on his or her emotional nature. And eventually, with a series of decision making that is included in trading, it becomes extremely important for an individual to understand how these decisions are made. You make money in trading out of the quality of your decisions. Now, when retail traders approach the market, generally they are either traumatized by fear or induced with greed. And these are basically the two ends of the stick, generally, on which their belief systems are operating. Sometimes they act very fearfully, and sometimes they act out of extreme excitement. Now, this is something which, on a broader context, is known by most individuals, and our human behavior is also the very essence by which the market moves. And human behavior is addictive, it is patternized, it becomes a habit, and man is a creature of habit. What eventually happens is that when the masses who participate out of emotions in the market end up creating those patterns on the chart also. Now, that is one part of the story, how price mechanism behaves. And price mechanism and strategies, etc., you can watch on my YouTube channel. A lot of free videos are there to teach you about price mechanism and technical analysis. Today, we're going to particularly talk about how, as an individual, you can understand, control, and streamline your behavior, optimize your behavior to get the best out of yourself in trading. The truly successful traders are the traders who understand that trading is not just a development of a skill, it is also a development of a self. And any endeavor which actually involves a certain kind of performance, be it a creative endeavor or be it a athletic endeavor, or in case of trading being an endeavor which involves performance, it becomes very important for an individual to be psychologically trained in order to do better. Mostly, the differences between the retail trader and the professional trader are very out there and very clear. It just needs the right eye to be seen. I have worked with a lot of retail traders, and I have taught them. I have taught them how to trade, I have taught them technical analysis, I have taught them trading psychology. At the same time, I have also worked with a lot of professional traders. I have learned from them a lot, and I have learned a lot via observation also. Observation being one of the key aspects of enhancing your aptitude with markets and any other business. What happens is that retail traders generally are the ones who involve themselves so emotionally with the market that after a point they get into habits like overtrading, or they get into habits like finding the hesitation before taking on a good trade. Whereas the professional traders are fearless about the outcome of one trade. They do not really bother so much about an outcome of a small losing trade. And at the same time, when it comes to hitting trades, they do it with a very unflinching confidence. Now, there is a different mindset by which the professional trader operates, and a very different mindset by which the retail trader operates. Understanding the difference will help you understand where you are, and probably, even though you are a retail trader listening to it, you could be someone who may have certain aspects of a professional trader and may have the correct strengths to leverage on that strength. Also, if you're a professional trader listening to this, it may be so that you have certain behavioral patterns which are very similar to that of a retail trader, and they are pulling you back from giving out your best performance. The broader emotions in trading, when people talk about, are generally fear and the opposite of that, greed or excitement or exuberance. And that's pretty much all people talk about. But we're going to take a step further and understand the various emotions that come out of fear, the various emotions that come out of greed. Let's understand them a little more deeply so that we can become aware of the emotions that are going on. Today I plan to take on a certain set of emotions, talk about them, and give you potential solutions that you could work upon. A growing trader is not necessarily just a trader who grows in money. A growing trader is also a trader who is growing in his skill set. A very important part of your trading skill set is trading psychology. We are in an ever-changing world and a phase where the financial markets have become very complex, have become very integrated, information has become very accessible, but at the same time, as much as it can become complex, there are equally expanding opportunities also. So, let's take up the first emotion I want to talk about. The first emotion I want to talk about is fear. Now, fear is something which perceivably in other businesses and endeavors may seem a little healthy. One may fear taking a big risk before being very clear about what his or her plan is. Similarly, in trading, when people come, they don't realize that it is not the same skill set or the same emotional quotient which works in the world otherwise is going to help them in trading also. A problem happens is that when they come with a lot of fear, the fear of losing money, or perhaps they are recently traumatized by a particular loss, or they have started out very enthusiastically and a series of losses taking them down and demotivated them. When that kind of fear exists, there's a lot of hesitation out there. So, branching out from fear, the first and the foremost, before you take a trade, the emotion of hesitation is very much prevalent among the retail traders. What happens is that if you have recently lost or you feel traumatized, the belief structures which within you speak of a lot of fear seem to be activated. And the moment you see a good trade, even though everything logically seems to be perfect according to your setup, to go long or to go short at that very moment, what tends to happen is that fear takes over and the emotions actually bring out all the logical reasons as to why you should not take a trade. I'll give you an example. When in my starting days, I clearly remember a very, very, very good trade which I could have taken. I could have held on to. It was a trade that came about around 3 o'clock, and 3:30 the markets shut down. I was very confident about everything around the trade, speaking logically, speaking according to my chart setup, and etc. At the same time, I was emotionally a little disturbed because I had certain losses which were really, really giving me a headache. I really thought to myself that since it was a Friday, I would not take any positions with me and I would really rest. I would give myself a break and not think about the markets for the next 2 days so that I could feel more revived when I come on the coming Monday. What happened is that it was a trade where I was supposed to go short. I did not. I did not take the short, neither did I hold the position as a positional trade. And Monday morning, the stock plummeted down, fell like a stone. And had I taken the trade, it would have made a lot of money to me. Now, one thing which I realized as I have passed a lot of years in trading is that those recent fears were actually not something to be worried about. Those recent losses due to which that fear came about led me into believing that probably I'm going to face another loss. And that is what made me hesitant. As a professional trader thinks I should have thought in not just about a few trades here and there. I should have thought about the long term gains. That in a long term, I'm going to have a series of a lot of trades which I'm going to take throughout my life. And of course, there could be one or two or three trades in a row that could be losing trades, but I should not get bogged down by them. Myself being hesitant costed me a potential big gain. Now, this was something I learned from very, very strongly. And although it can be very difficult to let the fear dissipate, because it was not the only time I faced this, I faced this again a few times. And every time it would be during the time when I have recently had a loss. The recent loss made me a little underconfident, and that hesitation kicked in. Eventually, I learned from these mistakes and tried to correct them. Now, at that age, when I was much younger, even though I was becoming more and more aware of myself and my trading journey, it was difficult to correct that. But one thing I realized is that if I start thinking in terms of not trade by trade basis, but in terms of the fact that I'm going to take a series of trades over which my performance will be judged, I stopped feeling the fear. I stopped feeling hesitant. I replaced my fear with the correct thinking, and I deflected my energies from fear onto thinking about how I will perform over a number of trades rather than just one trade at a time. So, when this change happened, I got over the feeling of hesitation. And this is something which I have found very, very important. That the hesitation which comes to most of the retail traders, because they have some sort of a baggage or a mental clutter of maybe not the recent loss, but generally having lost a lot of money overall in the markets, they tend to not get the journey started because they're very hesitant to take trades on. Now, in this scenario, one of the key things which one must understand is that one must not be undercapitalized to trade. If you are undercapitalized to trade, there will be a fear of losing money. If you have the fear of losing money, you are bound to feel the fear before taking the trade, when the trade is moving on, and eventually even while closing the trade, there will be some fear of regret. So, if we cut down and we split open this entire hesitation emotion, we understand its roots are, number one, in thinking about trading on per trade basis. Number two, on possibly being undercapitalized, because if you are undercapitalized, you probably could not take that loss and therefore you hesitated taking the risk. And number three, which is also very important, is regretting to take on the trade. A lot of hesitation comes out of regretting that possibly I will regret this decision later because I don't have the confidence right now. I don't think I'm in the mental state, even though you may be, but you want to hesitate. You want to feel comfortable in the pain of fear and hesitation. So you need to understand this, that the professional traders, when they are finding a good trade, their judgment to take a trade is not putting the ego in the equation. Now what happens is, when you put ego in the equation, it's not always that you want to call a top or you want to call a bottom. When you put ego in the decision making process, the ego coming in between makes a lot of things about you rather than making it about the market. If it becomes a lot about you rather than about the market, then there is a problem. The professional traders draw the ego energy from the entire equation and they see the trade as it is. Now, if the trade is an opportunity one might not even get in a matter of a few weeks, it is such a multiple time frame breakout, or it is such a long or short opportunity depending on the other factors, other technical factors or news based factors, or whatever the basis of one's trading could be. Okay, if the trade is a very rare precious gem, or possibly the trade is literally an easy ball to hit. They will look at it just as it is, and regardless of the fact that they may have had a recent series of losses or 2 or 3 losses in a row, or maybe one big loss also, they would go and take the trade. Now obviously position sizing over here becomes a question. As a professional trader, you need to understand that even their position sizing matters. And position sizing is extremely important for multiple reasons, which we'll come to. But it does get the hesitation part out of the equation too. So you can use your clarity about the position sizing. Now this reminds me of one of my students who once saw a trade and the lot size was 2000 shares. Now that young chap had the capital, but had he taken the risk on those one lot trade, it would have, and his stop loss, if they were hit, he would have lost a certain amount of money which he did not want to. It would have sort of taken his margin down, that he could not even take a trade of one lot later. So instead of taking the 2000 shares trade, he took a 500 shares trade, and he took that in a cash position. And his position, once he took the trade, eventually worked out for him. In his plan, he also added he had added the fact that if the price moves a little more against him after taking the trade, he would add a little bit to his position, another 250 shares, and see how it goes. Now, before you take a trade, the understanding of the technical patterns and the strategies which are involved is essential. If you take the trade and you have a well-defined stop loss, then it becomes very easy for you to understand exactly how much you're going to lose in case the trade doesn't work out for you. You need to understand that and position yourself in the correct manner. If you position yourself in the correct manner and plan to do so, the hesitation will automatically go down. My recommendation would be to take a trade where the loss does not get you out of the game, the loss does not hurt you emotionally, and the loss is not such a big amount that draws down your capital that it handicaps you from taking further trades. Okay, so you need to understand the very basic reason of your hesitation being fear, and the solution to that would be to think in terms of probabilities over a number of trades, not on one trade basis. Okay. The second thing would be to position size yourself in a manner where you don't hesitate, because in case you lose the money also, it is fine. It won't hurt you that much. Okay. Now, what happens and how the fear actually comes about when a person is trading during the trade? So one person who is a probably retail trader has taken a trade with hesitation, without hesitation, I don't know. But one very common thing happens is impulsiveness. The trade may have been taken out of a proper strategy, or maybe just plain simple short-term intuition. But once the trade starts moving in the person's direction, or maybe starts showing some jitters in price movement in and around the area of the position taken, one tends to feel very, very impulsive. Now, the impulsiveness which comes from within is again an output of the fear. And as I said, we're talking about different emotions which branch out from fear. The impulsiveness, feeling the lack of objectivity, leads to the trader getting out on a small noise or getting in and out of positions, and his decision making or her decision making becomes extremely random in nature. Now, with having random decision making, you cannot really draw out money consistently in the markets, because the markets in the very, very small time frames, if you look at every tick, also move randomly. It is just that as you go into slightly bigger time frames, probably a 5-minute or a 15-minute chart, or in some cases where volatilized stocks are there, then an hourly and a daily chart, and not less than that. When you come to a little bigger time frames, is the time when the market actually shows some sort of permanence in the trends and price movements. Now, what ends up happening is that, especially in case of volatile stocks or a little bit of noise after taking the trade, one tends to feel hesitant if fear is within them. You have to understand that it is the fear which is expressing itself in the form of that hesitance and impulsiveness. Now, this impulsiveness also causes a lot of traders to overtrade a lot. And if you overtrade, one thing is for sure: it is not going to make you consistent money. It will lose you consistently small amounts of money over a series of trades, which will end up becoming a bigger amount. Because overtrading means random decision making. And your decision making, if not valued and if random, it is not going to be every day that the market will trend so much to suffice your random decision making. It will take a few days of a sideways market to blow up an account. And this is a mistake I also used to make: over trading and impulsiveness. And then slowly I realized that if I have to give my technical views the correct expression in order to trade well, I need to let my view play out, let the strategy play out. Hold on to the trade. Don't worry about overestimating the entry point. It is okay not to get the best entry point. You need to give some space for the market to breathe. Now, the professional trader is generally not impulsive. Okay? If out of an impulse they take a trade, they do have the given required level of flexibility to exit the trade immediately, realizing that they have not got the confirmations which are required to be in that trade. The professional trader may also prematurely exit a trade in a smaller profit. The reason being, again, a degree of flexibility to see that the trade is working out, but not with that category of momentum. They sort out the trade before taking it. In these scenarios, the professional trader is extremely objective, and again, he or she keeps the ego equation out of the entire equation. They keep themselves aside, and they think if the market is showing the potential to move up or down, and according to that, they invite the flexibility. There is a subtle difference between this impulsiveness and the flexibility. The retail traders generally mistake impulsiveness for flexibility, which is not the case. In case the professional traders start doing that, they will lose a lot of money. But they don't do it. They do it only on very rare occasions. Generally, the professional traders have sought out a particular reaction point or a particular potential target area for the trade. If not that, they have sought out the particular wave counts and the spikes at which they would want to get out of their profiting positions. A small noise here and there after taking a trade does not mean that you get out of the trade, because most likely it could mean, given that your strategy is powerful and right, that the market is gathering the steam to move more in your direction. If you see this happening again and again, and yourself trading again and again with an overtrading impulsive behavior, understand that it is not supposed to be done, and that there's seriously things you need to work upon yourself. Maybe a lot of traders don't have a lot of confidence in their strategy. The lack of confidence in their strategy also leads to these kind of fears. In order to build upon strategy, you must learn how to use technical analysis in your favor. Consistency is the key. Ladies and gentlemen, any fear keeps you from consistency. Now let's talk about once the trade has gone against you and you've taken a loss, or once the trade when it has gone for you and you've taken a profit. If your fear activation is in the process and in the equation, even after booking a profit, there would be a certain degree of regret, and that regret is again branching out from fear. A lot of retail traders end up regretting. I get calls from people who tell me that, you know what happens, sir? That sometimes I take a trade, I exit, and it moves more in my favor. Now, I really don't have a comment to say unless I see the person's strategy in place and the particular market phase in place. But all I can say is that if that happens to a significant extent and again, there is something needs to be worked on. But many traders I have seen also regret because they see only one trade where they could have made a lot of more money had they held on to the trade, where they overlooked the 2-3 other trades where they exited almost at the right time. Now nobody is going to be able to easily catch the top or the exact top or the exact bottom. They could be exactly probably a few buyers and sellers, or one buyer and or one seller at the absolutely lowest or the highest price. Amongst thousands and lakhs of participants, there could be only those few. So don't really count yourself in the person who has to get the exact bottom to book the profits if you're short, or has to get the exact top to book profits if you're lost. If you get somewhere in and around a certain area of your price target and interaction zones, it is fine. You can book out the profits. Now what happens is that suppose the market extends the gains or extends the losses, goes further up, goes further down. From an objective point of view, say for example, I recently took a trade in which I was long and it came to my point of price target. I booked the profits and I saw it taking resistance for the next 1 hour around that target area. Now for me, understanding that objectively became very important, and I re-entered the trade as the price was surpassing that resistance area. I got another chunk of the move and booked profits there as well. But my action was completely objective. It was not out of the fear of missing out a move. Now, most traders who fear this kind of regret and sort of are completely stung with regret and the emotion of regret, they tend to make a very major mistake. And the major mistake they tend to make has got all to do with that regret branching out from the fear which is activated. Now, if you fear that you will lose money in the market, you'll probably want to make all the money out of one trade or a few trades. This is not the way. If you've got your targets, book the profits, move on, forget about it. Take the next best trade which is available. Booking profits is a skill by itself. The professional traders book profits because they see themselves as people who are accumulating money. They are not the ones who are supposed to, see themselves as making all the money for the year in one trade or making up all their last month's losses in one trade. It is always about a number of trades in a row, not a trade by trade basis thing. The retail trader generally is induced with a lot of fear, and in order to overcome that fear, the high impactful need of wanting to overcome that fear makes them hold on to the trade sometimes far too long and then miss the target price also. So regret or the fear of regret becomes an emotion again which stands between you and your consistency. See, ladies and gentlemen, while I'm talking about these things, note and make notes, pause this audio, note down some of these emotions which you have felt, some of the patterns of behavior which you have shown, and understand that something that works but not consistently, something that works but doesn't work for every trade over a series of trade, or just one works for one trade in the series of trade, is not good enough. Something that works consistently is required. Something that works consistently, even if it be that even if the case is that you book profits and the price goes further ahead, it's fine. But if booking profits at your target areas works for you consistently over a series of trades, is the best thing for you. Then, then rather than making all the money in one trade, think about consistency. Sometimes letting go of those money gains for the sake of consistency can be very, very healthy. Now, I chalked out these few emotions I would like to talk about today, which are related to fear. Now, let's talk about some emotions which are related to greed. Branching out from greed, the first, foremost emotion is that of exuberance. Exuberance that comes from greed. Generally, the retail traders display this emotion after recently having taken a profit or recently having had a profit streak. Now, if you've had a profit streak, obviously you've done certain things right. It's not a joke to have a profit streak. It's something you've worked hard for, and it's also something which you realize it needs to be preserved. This is the subtle difference between the professional traders and the retail traders. One of the major problems is that when we have faced a losing streak, we become very open to learning. We become very open to taking advice from another trader. But when we've had a profit streak, we are not very open to these situations. We are not open to learning. We feel that we are right. I continuously tell myself and tell my students that there are two major times when you should introspect or should seek advice or should seek mentoring or coaching. One, when you are either doing poorly, or the other, when you're doing really well. Because these two extremes are the places where generally problems start happening. For a retail trader who has shown himself or herself a streak not very often, but now has a profit streak, good going, you've taken your game up, you have learned something, you've done something, you've worked hard for it. No doubt, it did not happen with a stroke of luck. You did some things right. But the problem is, if you don't preserve it, it will not have any meaning. I'll tell you about a scenario. Once in my career, when I was going through a lot of ups and downs, I had my fair share of learning, guys. And in that fair share of learning, this was an important inflection point. I would go make money for one entire week every day. I would lose money one entire week in the coming week. Every time I made money, I would feel wow, I would feel amazing, I would feel I've really got somewhere, I've really done something. And somehow emotionally, that would actually be an output of exuberance, that excitement. I replaced happiness for excitement. I was wrong. That's one big problem with not just traders in the retail segment, but also this entire generation. Sometimes, or rather many times, we mistake stimulation to be happiness. Stimulations are not happiness. A lot of exuberance in the world in general causes problems like high spending, conspicuous consumption, irrational consumption, low savings rate, etc. This exuberance is not good for us or for the generation in general. Now, this exuberance in trading plays out when a retail trader has got a big profit or a series of profits, and then everything around him or her starts looking like an opportunity. Now, when the mind is induced with a spurt of certain brain chemicals, okay, now I'm not going into the biology right now, which I would in some other audio podcast, but not today. So, if the brain is induced with that feeling of excitement and the feeling of winning and the feeling of confidence, that somewhat tilts into the overconfidence space. One forgets that he or she also needs to perceive the risks involved. It is taking the risk which has led to profits or a streak of profits. And the other side of the risk must not be ignored either. If you've been right in the markets and taken good trades one after the other, learn to preserve. This is what is a very subtle and almost invisible difference between the retail and the professional traders. Because when one is doing well, one does not find the need to look for self improvement. And this is, in my opinion, a bigger trap than having a losing streak, also. It is like a honey trap many retail traders get into. They find themselves taking profits after profits, and with that feeling of overconfidence, they end up taking either a very big position size, or they end up taking a erratic move as a confirmed trade. They would jump the gun on any uptrending or downtrending move and expect themselves to make profits out of it, and probably do that also on very high leverage. Or take one good trade, but they would take it on such high leverage that a little bit of noise would get them out. Sometimes it also happens that there's a preservation bias in place, and after the exuberance is there, one tends to feel all the more fearful that, what if I lose the money I have already made? Now, I would not say that's a wrong feeling, because you should not be too excited also. At the same time, you need to be having certain gaps in your decision making in order to preserve the quality of decision making. Exuberance involves taking one trade after the other, which again is not supposed to be done. You need to step back, make a valued opinion, and find the market in correct alignment with your trading psychology and your trading strategy. The market cannot be in your trading psychology, but you should be in alignment with your proper trading mindset and trading psychology, and let the market be in alignment with your trading strategy. If you've got that done, and you've taken the next step after having a winning streak, the most important step to be taken is to pull back a little bit and understand that I need to preserve my profits. Now, obviously, when the market is in flow and everything is going, you would not want to pull back. At that time, one of the recommendations which I give to my students who do very well is, if you don't want to pull back, relax and trade small. Trade smaller than you would generally trade. Now, this also involves the level of probability the strategy is playing out. So, suppose you've got a streak of wins, a streak of profiting trades, and you find yourself sitting with the market and a fabulous trading opportunity has come up. Then I would say, go for it. But I don't mean to say that you go for it with double or triple the position size. Go for it with the same position size you would have gone for a trade in general, in which you make the profit streak. If you follow these steps, you will be in a better position to plan out your trades and draw the energy of exuberance or excitement out of it. Exuberance and excitement are not very healthy for your trading, because the most important part of trading is risk management. And this is something which gets you completely on the opposite end of the stick of risk management. Now, we need to see this in a holistic point of view. Let's understand what other things happen which are coming and branching out of greed. Out of greed, sometimes this exuberance doesn't happen, but out of greed, sometimes over position sizing happens. Over position sizing. Again, I've already mentioned a little bit about it, but now, out of greed, over position sizing is a very important factor which pulls down a lot of traders even before they start their game. So imagine the first trade which you're about to trade. You've never had a trading account, you have never traded in your life, and you're all excited about the markets. Okay? In a way, you're greedy. You don't know that trading is not just about going and making the money. It is about really setting up a foundation, a skill set, in order to do so consistently. But you have narrowed down your expectation to one day, one moment, one stock, and one direction. And you say, okay, I want to go and buy this stock today because I like this company. You go and buy this stock on And out of greed, you do it with your entire position sizing possible. And suppose that is not the day the stock is going to perform well. It's not going to be, since you've gone long, it's not going to be bullish. Suppose it is bearish. And you lose a lot of money on that standing position. Now, over position sizing is a huge problem. It just happens out of extreme greed. Also, it happens because sometimes people want to make a lot of money in just one trade. That's not how it's supposed to be done. Again, the solution is to think in terms of probabilities, think in terms of a number of trades rather than thinking in terms of only one trade at a time, and understanding that even if it is the best trade out there, number one, it has the potential to go wrong, so don't be that greedy. I would like to also coin this term called intellectual greed. I have been a victim of this. Believe me, it is not easy. It was something tough to get over. But having done a lot of research on technical analysis, on charts, etc., once I saw something as something superbly high probability, I would pull the trigger and go with a very high quantity sometimes. And if it turned out to be wrong, I would lose a lot of money. Now that was something which I call intellectual greed, because I made my intellect and made my way of looking at the chart as a reason to take that bigger position. In nature of the emotion involved, it was purely greed. But the reasons I felt for the greed was that I am clear about it, I am good at understanding price mechanism, and I should just pull the trigger because what else am I here for? Now, it is right that I am here to actually express my views through my capital, through my trading capital, but it is also important for me to understand that I cannot over position size myself just because I find this one trade to be extremely well poised for a move. No matter how good the trade is, no matter who you are, how good as an analyst or a trader you are, it is always possible that the trade will not work out for you. It becomes a difficult pill to swallow, but you have to understand that no matter how good you are, you always stand in a 50-50 probability of making or losing money. Objectively speaking, a 50-50 probability of making or losing money on a certain trade. Now, subjective probability is what analysis is all about. Subjective probability is what any discretionary trader or investor builds his life, career, and wealth upon. Now, if we have got to understand the subjectivity around it and come face to face with the objectiveness which we need to display, we cannot have high position sizing. So out of greed comes also an intellectual greed. And this is again which professional traders know how to handle very, very well. I have also seen this to be the professional traders' challenging point, because professional traders are very used to the market price mechanisms. They also tend to find themselves, sometimes, not always, very, very greedy by taking a high position size on something that looks like a high probability trade. Now, suppose that trade does not work out for them. What happens? They lose a lot of money on that one trade. Again, they're not supposed to do this. But professional traders are good at handling their emotions and growing their skill. Whoever, as a professional trader, has asked me questions on trading psychology, one of the most key points has been this, that I end up taking a big position sometimes on what looks like a high probability trade. Now the thing is that once those kind of trades work out for them, there is no complaint. But if something doesn't work from them, it is very, very painful. The answer to this again is to lower your level of expectation and greed and focus on the position sizing. If you take a number of trades until you grow your account, until you genuinely and consciously want to and decide to increase your leverage, carry on taking an equal position size in every trade. or sort out a slightly higher position size for something high probability, but not double or triple your regular position size. Okay, so on this note, I will end this podcast right here. I hope that all of you enjoyed listening to this, found some solutions. If you have questions, wherever you're watching this podcast, even if it is on YouTube, you can type in comments. And for more to know about me and what my team do, go to www.technicallysorted.com. Have fun, ladies and gentlemen. I'll see you until the next episode.